Bitcoin just crashed below 65k. Ethereum is bleeding. Your portfolio is down 30, 40, maybe 50%. And every instinct in your body is screaming at you to sell. But before you press that button, I need you to hear something. The people who are about to make life-changing money in crypto, they're doing exactly the opposite of what you are doing right now. And after this video, you will understand why. Let's break down what actually happened the last few weeks, because the headlines are only telling you the story. Yes, Bitcoin crashed 12% or even more. Yes, it fell below $65,000. But the real story isn't the price. The real story is why it crashed, because that why tells you what happens next. Here are the three forces that converged to create this crash. First, ETF outflows hit record levels. Throughout 2025, institutional buying through spot Bitcoin ETFs created a persistent demand flow. In Q1 of 2026 alone, those ETFs saw $18.7 billion in inflows. But in June, that flow collapsed. US spot Bitcoin ETFs saw record outflows as institutional investors pulled back. When the biggest buyers in the room stop buying, the market doesn't just dip, it free falls. Second, macroeconomic headwinds. The Federal Reserve's stance, rising geopolitical tensions, including the Iran situation, and the broader risk-off environment hit crypto harder than traditional markets because crypto trades on leverage and sentiment. When fear enters the system, leverage positions get liquidated and liquidations force more selling. It's a cascade. Third, and this is the one nobody is talking about, the structural reset. The crypto market went through a massive expansion in 2024 and 2025, driven by ETF approvals and the narrative of institutional adoption. But adoption without infrastructure is just speculation. The market grew faster than the underlying systems could support, and this crash is the correction. Now here is the part that should make you pay very close attention. Ethereum fell even harder than Bitcoin. It dropped from over $2,000 at the start of June to below $1,700. That's a 15+% decline in under 2 weeks. Standard Chartered is predicting $7,500 ETH by the year end, but technical analysis shows bearish targets at $1,760, $1,400, even $1,000. The gap between institutional optimism and market reality has never been wider, and that gap, that is where opportunity lives. In one of the previous episodes, I told you about the institutional invisible hand, the quiet force that moves market while retail investors are looking the other way. Well, let me show you exactly what that looks like in practice. While retail investors are panic selling, while Twitter or X is full of crypto is dead posts, while your group chats are in full meltdown mode, institutions are making their biggest moves of the year. BlackRock's Build Fund, that is their tokenized money market fund, crossed $1 billion in AUM in March 2025 and now approaches $3 billion. It operates across Ethereum, Solana, Polygon, and BNB chain. They are not retreating from crypto. They are building the infrastructure to own it. Wall Street is moving past crypto pilots and going deeper into Ethereum. The founder of Etherealize said it himself this month. Wall Street is moving past experiments and into deployment. Now here's the real kicker. While Bitcoin and Ethereum ETFs were bleeding, a brand new ETF, the Hyperliquid Hype ETF, attracted nearly $160 million in inflows within days of its launch. Even as the market crashes, capital isn't leaving crypto, it's rotating. Smart money isn't exiting the building, they're just moving to different rooms. Grayscale's 2026 digital asset outlook called this the dawn of the institutional era. They expect more crypto assets to be available through exchange-traded products this year. And Silicon Valley analysts say 2026 is crypto's integration year, the year it stops being an alternative asset and starts being embedded in financial system. The crash isn't the end of the story though. It's the end of the first chapter. Every previous crypto crash had one thing in common. There was no floor, no rules, no safety net. When the market crashed in 2018, 2020 or 2022, it was a free fall because there was no institutional infrastructure, no regulatory clarity, and no mainstream financial integration. By 2026, this is the first crash with a safety net, and that changes everything. The Genius Act, the Guiding and Establishing National Innovation for US Stablecoins Act, was signed into law on July 18, 2025. It requires stablecoins to be backed one-for-one by US dollars or low-risk liquid assets. It mandates monthly reserve disclosures, and it becomes fully effective on January 18, 2027. This isn't a proposal. It's not a framework, it's law. Why does this matter during a crash? Because in previous crashes, the stablecoin market was a black box. Nobody knew if Tether was actually backed. Nobody knew if USDC could survive a bank run. The fear wasn't just about Bitcoin going down, it was about the entire ecosystem collapsing because the stablecoins might not be real. The Genius Act eliminates that fear. When stablecoins are legally required to be fully backed, they become a safe harbor during storms. And that means the floor under this crash is fundamentally higher than it's ever been. And it's not just the US. In Kenya, where I'm based, the Finance Bill 2026 is proposing that crypto exchanges share user identities and transaction records with the KRA, that is the Kenya Revenue Authority. The Central Bank of Kenya will handle stablecoin licensing. Kenya's blockchain industry is pushing for faster stablecoin adoption, and Kenya just passed the Virtual Asset Service Providers Bill, a landmark law that regulates crypto and assigns shared responsibility to existing regulators. Africa is not running from crypto. Africa is building the regulatory framework to make crypto permanent. And when frontier markets are building foundations while developed markets are panicking, you need to pay attention to where the real conviction lives. Alright, here's where it gets really interesting. While everyone is staring at Bitcoin's price chart, the smartest money in the world is flowing into something most retail investors don't even know exists. RWA, Real World Asset Tokenization. The tokenized RWA market hit $33.69 billion in distributed asset value as of May 2026. That's a 256% growth in just 15 months. Tokenized treasuries alone surged 539% to reach $5.5 billion. Fiat-backed stablecoins grew from $128 billion to $225 billion. BlackRock's Build Money Market Fund is approaching $3 billion and operates across 4 blockchains. This isn't speculation. This is the financial system rebuilding itself on-chain. The top crypto narratives for 2026 are no longer about meme coins or NFTs. The 5 real narratives are real-world assets, AI plus blockchain, deep-in modular blockchains, and prediction markets. Each of these has one thing in common. They represent real economic activity, not just speculative trading. The market is telling you exactly where it's going. The question is, are you listening? And let me connect this back to Africa for a moment. Kenya's crypto industry is pushing for faster stablecoin adoption because stablecoins solve a real problem here: cross-border remittances. When it costs 12% to send money from Nairobi to London through traditional channels, a dollar-backed stablecoin that costs fractions of a cent isn't just an investment, it's a lifeline. The adoption drivers in frontier markets aren't speculative, they are practical, and practical adoption is what survives the crash. Here are the 5 rules for the 1% that will serve as your crash playbook. Rule number 1. Don't panic sell into a structural correction. This crash is driven by ETF outflows and macro headwinds, not by a fundamental breakdown in crypto's value proposition. The blockchain still works. The smart contracts still execute. The institutional infrastructure is still being built. Selling into a structural correction is like demolishing your house because the neighborhood is under construction. The construction is going to make your house more valuable. Wait it out. Rule number 2. Rotate. Don't retreat. Smart money is not leaving crypto. It's rotating from speculative assets into infrastructure. RWA tokenization, stablecoin infrastructure, DePIN networks, these are the sectors that will absorb the capital flowing out of Bitcoin ETFs. If you're going to adjust your portfolio, rotate towards what institutions are building, not away from crypto entirely. Rule number 3. Dollar cost average through the crash. If you believe in the long-term thesis of crypto, and after everything I've shown you today you should, then a crash is not a threat. It is a discount. Set a weekly or monthly buy order and execute it regardless of the price. The 1% don't time the market, they accumulate through it. Rule number 4. Track the data, not the sentiment. Delete the panic from your timeline. Instead, track on-chain flow data. Watch where stablecoins are being minted. Monitor RWA fund inflows. Follow what BlackRock, Fidelity, and Deutsche Bank are building, not what your group chat is panicking about. Data is the antidote to fear. Rule number 5. Position for the regulatory flow. The Genius Act takes full effect in January 2027. Between now and then, stablecoin infrastructure is going to be the fastest growing sector in crypto. Every major financial institution needs to be compliant, and compliant means on-chain. Position yourself in the infrastructure that compliance demands, and you'll be standing on the regulatory floor when the next wave hits. Let me be real with you for a second. I know what it feels like to watch your portfolio bleed. I know the knot in your stomach when you see red numbers. I know the voice that says, just sell, cut your losses, walk away. I have been there. And I'm not going to pretend that this crash does not hurt, because it does. But here's what I also know. The people who are going to build real wealth in crypto are not the people who bought at the top and sold at the bottom. They are the people who understood the difference between a crash and a collapse. A collapse means the system is broken. A crash means the price is wrong. The crypto system is not broken. The price is just temporarily wrong. And a temporary wrongness is where permanent wealth is created. If you haven't watched our previous episode, do it now. It explains the foundational principles that make everything in this video work. And if you want more analysis like this, more research, more data-driven crypto intelligence from Nairobi to the world, subscribe to this channel, hit the notification bell, and tell me in the comments, are you holding, selling, or buying more right now? I read every single comment. There you have it, guys. Stay sharp, stay calm, and I'll see you in the next one. Cheers.